Hello guys, welcome back to another video in the Finance with Python series. This is Anirudh here, and today we're going to look at a finance-based time series analysis. So here I have, taken a bunch of stocks and commodities like gold, and I have, tried to do some time series analysis of it. So this is like a from scratch video which involves all the libraries that we had seen in the previous videos, like Pandas, NumPy, Matplotlib, Seaborn, and so on, Y Finance, so on and so forth. So let's get started with it. So here I've just imported, the necessary libraries like NumPy, Pandas, and so on. And we have, tried to take different stocks like you have the Apple, Microsoft, Intel, Amazon. This is Goldman Sachs, this is gold, and so on. So let me just run that real quick. And we just want to download data for like the last 5 years, which is from 2020 to 2025. Okay, so loading. Hmm. So now you can see what are all the columns that are present, in our variable data. So data has downloaded all these, stock data, right? Stock and commodity data over the period of 5 years. And you can see what all are, the column names. So you have the closing price for Apple and other stocks and commodities, the highs, lows, open volume, etc. So now let's, try to plot the closing stock price, as time progresses. So these are just basic matplotlib command where you are just referencing the closing price of a particular stock. So here you're iterating through tickers, and tickers was defined here, which is a list. So tick this variable takes each and every element of the list, takes the closing price, and plots it here with the x-axis as date, right? So that's what you've done here. So you have the Apple stock, Microsoft, Intel, and so on and so forth. Okay, Intel has heavily dropped in the last 5 years. That's a very big drop, right? From $60, I suppose, to $23. Oh, 23, 24. Let's check Intel stock price. 21. Okay. And yeah, this is the same data. So it was around 60 and 21 right now. So this is exactly what we've plotted here. It's just that maybe, this is a bit more stretched out. Let's try to do that. So maybe I could adjust the, yeah, I think this is better, right? So I have just tried to increase, this x-axis length so that it resembles more like how it's shown in Google stock data, right? So now I think these two look pretty similar. Let's probably have a side-by-side comparison of it. Where is Intel? Intel. Okay. Yeah, it's just that it's a bit enlarged. We can fix that. Let's give this as maybe 3. I think 3 should work. Yeah. Mm, yeah. More like, yeah. Now I think it looks much, much better. But I think this is the figure size they have used for, doing it in Google. Whatever. This is what they have used here also. Right, so let's just move on. I just wanted to show you, how to change the dimensions and give like a figure size and all of that. So these are very basic stuff. We already covered this in, the tutorials. Now let's move on. So yeah, this is just data.info. Okay. Now here what we are trying to do is we just want to reference the closing price and the volume of the stock. So what the dot described does is it gives you certain statistical measures for the variables that you have taken over here. So here we have taken close and volume, right? So it gives you the statistical measure like mean, standard deviation, the minimum, maximum, and the 25, 50, and 75 percentiles, and so on. The round off to just basically means that you're just rounding off to two decimals. Like you can see here, rounds off to two decimals. Similarly here, so on and so forth. Right. So we have tried to get some data about the closing price and the volume price and some statistical measures regarding that. Now, let's say if you want to selectively, get this minimum column, the mean, standard deviation, the median and max. You don't want the 25, 50, and 75th percentiles or the count. So you can selectively choose these rows alone by using the aggregate function. So what the aggregate function does is, um, you can give a variable here, like I've given data of close, and you can just combine these few rows, right? You can give these rows, you can combine them and make it into a new table. And that's what we can see here. Yeah, so you get these columns alone instead of all of these. So maybe you're just trying to make the amount of data that you're seeing more concise so that maybe you can understand something better from it rather than looking at all of this. Maybe if you look at something like this, maybe something might strike you, right? So here now we are trying to take the difference between two consecutive rows. So this is mainly to, check the difference between the closing prices or the change in the amount of volume that's being traded, right? So obviously the first column is filled with NaNs because there is no previous row behind it, but values start coming from the second column. So this value is essentially got by subtracting the value here in the original data table minus the value here. And that is what this value is. That's what this reference is, right? So we have just given a dot difference function, takes the difference of consecutive rows, the values in the rows, and puts it over here. So here you can see that let's look at closing price of Apple, how it's varied. So it's varied by 0.28, then 0.38, then when negative, highly negative, again, so on and so forth. But see, maybe uh, difference is more like I don't think it'll give you that much of information because the difference of a stock can be subjective. So let's say there's a stock for $100, it becomes $105. So that's $5 of difference, right? But that's not the same as $1,000 stock becoming $1,005 because the percentage change is much higher when $100 stock becomes $105. So that's what I've tried to do next. So instead of taking the difference alone, taking the percentage measure between the two consecutive values is much easier to. It's much more valuable. And then probably now that we have looked at percentage change, you can see that this is more intuitive to understand rather than dealing with actual values. You can look at the relative percentage change with respect to the initial value. So these are the initial values. Okay. Okay. Now here we are looking at the average daily returns of a particular stock commodity. So here we have, taken the closing price and the percentage, relative percentage change. We've tried to take the mean so that, it's uniform across the whole time series of 5 years. And we have plotted, the average daily percentage of daily returns that you can expect from the stock. That is what is given over here. Average is the mean, percentage change or percentage returns, as I call it, of the stock price. That's what this means. Taken and plotted it. You can see that, Intel has been consistently giving you negative returns. So this stock is probably good for shorting, right? Since it's giving you steady negative returns, I think traders should short the stock. Anyways, so these are some things that you can do. Maybe I should also add like a, you know, title. So I can say the title of this is going to be daily average percentage returns. I think this works. Yeah. Oh, what happened? Oh, I think I had to give it here. Daily average. I think now it should work. Yeah. See, what happened is, I had given the title before I had, plotted the bar. So what happened is it just ended up creating a new figure, right? A new figure. So yeah, that's what happened. So now we have the title over here. Now I think it looks pretty good. Maybe we can add, the X label and the Y label. Yeah, I think now it looks much, much better, much more informative, I would say. So yeah, let's move on. Now let's look at logarithmic returns. Okay. So why would anyone want to use logarithmic returns when here we have already looked at first initially we looked at the change or the difference without using percentages or without having anything relative to it. Then we looked at using a relative term so that it's sort of normalized. Instead of having $5, $10, you can look at it as a relative percentage change. So I think that made more sense rather than just taking the difference, right? Now, what we're saying is let's probably look at the log of returns. Logarithmic returns are often preferred in financial analysis over simple percentage returns for several reasons. For several reasons. So these are some of the reasons. So let me just tell you about them, each one of them. So time additivity is the first one. So log returns can be added across time periods to get the total return over a long period of time, and this is not true for simple returns due to compounding. Yeah. So the main, if you look at the properties of how a log function works, this is pretty much self-explanatory, right? So you can add the log returns over a period of time to get the total return over a period of time. And okay, normality. We generally like normality because it tells you, you know, which percentage of return tends to be the maximum, which is in the middle of the normally distributed graph. So, and it's also visually appealing and it gives you more information. So we look like normally distributed graphs. So log returns tend to be normally distributed than simple returns, which is a desirable property for statistical modeling. This is the second reason. Third reason is, yeah, just like, since the graph is normally distributed, it's going to be symmetric, right? And log returns are symmetric around zero. So which is even better. So this is like a standard normal distribution, if you get what I'm saying. So let me just show you what a standard normal distribution looks like. Distribution. Okay. So standard normal distribution is about centered about zero. So that's one of the best, uh, you know, advantages of using standard normal distribution. And when you want to do some statistical modeling on this data, the log return sort of gives you a good way to perform these calculations. So as you can see here, a 10% gain and a 10% loss have the same magnitude but opposite signs in log returns, unlike simple returns. Right. Yeah. So that was just a brief about why logarithmic returns should be used. So here, we're just trying to calculate the logarithmic returns. We've taken the data close of the current and the data dot close price of the previous day, dividing it, and then we get the returns. That's what we've done here. And now, what is this? Now we have, tried to take all these returns. So as I've add side here, you can add the log returns over a period of time to get, the total returns over a longer period, right? So that's what you've done here. We've tried to compound all these returns over a period of time, and we have just normalized it by, taking e to the power of log so that you get a value. Like use e to the power of log of x is just x. E, e power log 10 to the raise e is just 10. So you're just applying the exponentiation over here and plotting it. So here you can see the total returns. So it starts from 1 and either goes down or goes up. And this brown line is of Intel, right? So here we're just, we're taking the cumulative sum of all the logarithmic returns, and we are taking e to the power of the cumulative sum. So what it essentially does is you take the exponentiation of the cumulative returns, right? So then you get the simple term or the growth term, like you get this particular term out of it, since you're doing e power log of this term. So we had seen that the log of returns is just the current price versus the previous day price. Right, so that's what we've done here. And this is the example of time additivity, this property that we have seen here. So we've showcased that property. Now maybe, this looks a little messy, right? And maybe you want to look at something that's a bit more smoother. So what I've done is instead of taking a daily sort of frequency, you're taking a 1 month frequency. So wherever the stock price is on that month's end, we are plotting that. So I think now it looks much, much more smoother, right? So that's what you've done here. So yeah, this just changes the frequency to a monthly time period. Label equal to right means that you see, since you can either take returns based on the first day of the month or the last day of the month, but here we've chosen to take the last day of the month, and dot last means we're just referencing it to the last value found in that particular month. Okay, so this is what it means, and then we are just plotting it. Resampling. We had already seen this part. I've just explained this plot, and now we've plotted it. Now, probably let's now look at some statistical, you know, methods or calculations that are also done. So here, what we've tried to do is we are trying to take a window of 20, and then we are calculating the various measures. There are central measures of tendency like maximum, standard deviation, minimum, the mean, so on and so forth. So what this essentially does is we are taking the a 20-day difference, right, between the max, standard deviation, minimum, and mean. So that is what rolling of 20 means. We have run this. Now, so using this, we have created a new column in the data table called exponential weighted moving average, or EWMA. So we have taken the closing prices of Apple and we have tried to calculate the exponential weighted moving average. And we have two parameters here. So the minimum period equal to 20 means that only after the first 20 periods it will try to calculate the exponential weighted moving average. And half-life equal to zero point 0.5 is the sort of decay rate that is applied on these weights. So decay rate of half means it gets half after every day or every iteration. And if you give smaller values for half-life, it means that more amount of preference is given for current values rather than past values. So that is what exponential weighted moving average does. And now we have tried to plot like the mean, max, and exponential weighted moving average for the last 200 rows in the data. So, and we have also tried to differentiate all of these three measures using green, red, and blue dotted lines. And this is just the line width that you represented. Now you can see this beautiful graph over here with the legend, right? Now moving on, rolling statistics. Yeah, that is what I had shown you over here. Okay, where was it? Yeah, here, exactly. So, yeah, as I was saying, rolling statistics is a major tool in the so-called technical analysis of stocks. It's compared to fundamental analysis, which focuses, for instance, on financial reports and strategic positions of the companies whose stock is being analyzed. That's what fundamental analysis does. A decade-old trading strategy based on technical analysis is using two simple moving averages. So in the previous video, I had showed you simple moving average, right, to plot the stock. So I'd taken, I think, simple moving average for a 50-day time period and a 252-day time period. So, and exponential weighted moving average is much more, a useful and more advanced measure. And the idea is that the trader should go long on a stock or financial instrument in general when the SMA, shorter SMA, is above the longer SMA, and go short when the opposite holds true. So yeah, here we have also tried to take the SMA, simple moving average. We've already taken the exponential weighted moving average, right? So we take simple moving average. Let's run it. So we have taken two SMAs. This is the short time period SMA, and this is the longer time period SMA. So here it states that traders should go long on a stock, and the shorter SMA is above the longer SMA. So if SMA 1 is greater than SMA 2, then he should go long on the stock. Agreed? And vice versa if the opposite holds true. Now let's try to plot this and check if we should go long or short the Apple stock. We have tried to plot this over here. I've given it like this using a new variable because we are referencing two variables here. So it becomes just a little complex to give this, inside the dot plot function. So I was thinking of making it simpler in this manner. So here, let's see. Whenever SMA1 is greater than SMA2, we go long. So everywhere you can see SMA1 is greater than SMA2, right? So we are going long, and you have seen that the stock price has always increased. Sorry. So it's useful to go long, right? So starting from here, the SMA2 is always lesser than SMA1. So it's useful to go long. But now when it dips, you can see that the SMA1 has dipped below the SMA2. And so it's okay to go short. So you can short it maybe at this position, exactly where SMA1 went lesser than SMA2. So that's around here, and sell it somewhere here. So you get this small profit. Yeah. And again, you can use this strategy and go long here when SMA1 outperforms SMA2, and then it's a full uphill. Yeah. So that's a strategy that many traders use. So now, yeah, since we had also tried to take a position, so we are also noting it down on the data frame. So we are having a new column called positions, and we're representing it as 1 if you want to go long and -1 if you want to go short. So let's go ahead with that. Okay, this is the same plot. I don't understand why secondary underscore y is not getting plotted. Okay, now I understand the problem. We needed positions inside this, right? We want to put that also inside this. So maybe let's try to update AAPL underscore data equal to, maybe let's try to copy this. It's for you. And where is it here? Let's also give another positions data of positions. Yeah, perfect. Now I think it should work. I know we don't need this. Let's take that out. Now maybe let's try. Let's just try with the positions. Yeah, works. Okay, so that was just a bit of tweaking, and now we can look at what position we should take. So this is a much more interesting graph. So you can see where exactly to go long, where to sustain, and where to go short. So this red graph represents the. Okay, now it works. So I think the red graph now represents where exactly to go long, where exactly to go, short on the stock. This is a very, very useful graph to have. So you are sort of comparing the SMA1 and SMA2, and using the red position graph, you are trying to assess when to go long and when to go short. These are very, very powerful and useful stuff. Okay, now that we've seen this, let's go to correlation. Although there is not much correlation between all of these stocks, let's still look at the correlation. So let's just run this and show you what it means. So what is correlation? Correlation is this sort of measure that tells you how correlated to things are to each other. So we can take the correlation between it, the fact that will it rain today, given that it's cloudy. So it it's these two are correlated, right? So if it's cloudy, there is a certainty that it will rain, and correlation gives you the sort of measure or the probability of it raining. I think that's how we can understand it. So here we have just used the SNSC1 library and used a heat map from it. So this is a heat map, which is a very visual representation of the different the correlation of different variables. So that's what I've done here. This is a very simple thing and very useful thing to see. This is something interesting. So gold and the SPY stock have a 0.84 correlation, very, very high. Similarly for Microsoft and SPY, Apple and SPY, very, very high correlations. So, so the SPY or S&P 500 has a very big, huge correlation with the Apple stock and the Goldman Sachs stock and the Microsoft stock. So whenever the S&P 500 rises, Apple rises, and you can see that when Apple rises, Microsoft rises, so on and so forth. A lot of correlation, a lot of interesting things to understand from this. Now let's try to compute the Sharpe ratio. So what is the Sharpe ratio? Sharpe ratio is this sort of measure that compares the return on an investment by taking the risk. So this is popularly used in risk analysis, and it gives you a measure of whether it's worth taking the risk or not. Let's look at that. So we can see that. So here, yeah, we can see the Sharpe ratios. Oh, returns happening here. Think, not sure what happened over here, but why does it show a lot of NANs? Oh yeah, we didn't take the NANs from returns dot drop NAN. No, in place equal to true. Yeah, now I think it should be fine. So you've dropped the all NANs from returns, and I think that's why it was showing NANs. Now maybe let's try once again. Yeah, GDX. Okay, returns. Why does GDX show NANs? GDX minus infinity. Oh, okay. That's the reason. So maybe let's try to remove this. This is all part of the data cleaning process, right? So sometimes, there'll be certain outliers like minus infinity. So we did not know this all along, even when we try to visualize it, right? So I think here we are taking the log and maybe there was log zero, I think, and that gave you infinity. So that's the problem, log zero. Log zero is undefined or I think infinity. That's the reason it's minus infinity here. So maybe now let's try to remove this. Okay, now what we can do is okay. So now we have resolved this problem. So we have a minus infinity over here. So what I did is I just replaced the infinity and minus infinity values. So just in case there is an np dot infinity over here or a minus infinity over here, I'm just going to replace it with an nan value. So let's just say returns equal to returns of, now what I'm going to do is now returns will have an nan value instead of a minus infinity, right? So I can just say returns dot drop nan in place equal to true. Now I think this should work. Now let's look at returns. Uh, yes, we have the column is gone. Great. Now let's look at calculating the Sharpe ratio. Yeah, now it reflects for every other stock. So perfect. Stuff like this might happen. So, anyways, we managed to resolve that. So again, Sharpe ratio is a measure for, it gives you the measure of returns versus risk. You're taking the returns versus the risk-free rate that we are defining. And he's just taking the mean by the standard deviation of the excess returns, and this is what the Sharpe ratio is. And then we are just printing the Sharpe ratio for every stock. Now here, this is the last thing that we're going to see. Here we are trying to look at the volatility of the stock or how much the stock price moves, right? So we have taken the rolling window to be 20, so 20 days, and volatility is just the standard deviation of, in those 20 days, how much the standard deviation of the closing price over a window of 20 days. And we've plotted the volatility. So this is the graph. Maybe we can just run it again. Yeah, so you can see the volatility of every stock and all of this. So with this, our video is over. In this video, we had looked at, some rolling statistical methods, why it is important, why you should use logarithmic returns. You looked at some correlation matrix using the Seaborn library and some data manipulation over here. So when problems like this occur, you see things like this very late. So the problem was, I think, when I took the logarithm over here, the log returns. Let me go over that. Let me just explain to you what happened. So when I took the log returns over here, I think just ended up being zero. So it just gave me a minus infinity, I think. And when we tried to, take the Sharpe ratio, then we came into this sort of problem. Or maybe it was because of something here. Maybe the standard deviation was negative zero. Or maybe that's one of the reasons why it became minus infinity. So there could be a variety of reasons somewhere in between. So that's mainly the reason. So we had looked at how to correct that. Great. And yeah, that's all for this video. And I hope you guys have now come to, sort of learn how to work with time series data, the different libraries that are used in this, how to do data handling manipulation, and how to graph the time series data. So this is what I had covered in this video. This is a fairly long video, and I advise you to take your time with it. Thanks for watching, and stay tuned for the upcoming videos. Thank you.